I'm singing to the choir here, but whether I was singing to you or I was on CNBC right now, I'd say the same thing. The physical bullion market is changing for the better, while the paper market, particularly one that has been running what I've nicknamed, and I'm not the only one, I call our COMEX the CRIMEX, that may still have an influence, but it's deteriorating and it doesn't have the long-term effect that it once had.
PeterGrandich, a former head of investment strategist on Wall Street, has raised concerns about price manipulation in the gold and silver markets, particularly in the realm of paper trading, where assets are traded on paper rather than in the form of physical metal. Such price manipulation is a common phenomenon in financial markets where traders attempt to exert influence over prices. In the past, governments and central banks have been known to suppress gold and silver prices by flooding the market with substantial quantities of physical metal. Bullion banks, acting as complicit brokers for governments, trade a combination of actual physical precious metals and paper assets like futures, options, and exchange-traded funds. The Federal Reserve, akin to the Bank of England in the United States, recently maintained borrowing costs within a range of 5.25% to 5.5% after a series of monetary tightening measures aimed at controlling persistently high inflation over an 18-month period. As a central bank policy, the Fed, like its global counterparts, strives to uphold long-term inflation at a 2% level. According to minutes from their September policy meeting released Wednesday, most Federal Reserve officials said they expected one more rate hike last month. Some officials said how fast inflation cools in the coming months will determine how long rates remain elevated. PeterGrandich notes that unexpected increases in interest rates have the effect of strengthening the US dollar. Typically, a stronger dollar prompts individuals to sell gold and silver. Before diving into PeterGrandich's interview, subscribe to our channel and give this video a big thumbs up.
So I have the Monday morning quarterback because if you interviewed me 6 or 12 months ago, I would have told you, no, we're not going to be back at low 1800s on gold and silver under 20, dollars possibly, and that type of stuff. The Monday morning quarterback analysis is, wow, interest rates went a lot higher than we thought right away. The dollar, even though we have all the reasons that you and I just discussed, fundamentally, it's terminally ill, rallied because of that. And the natural tendency for people was to sell gold and silver in that environment because supposedly that's what you're supposed to do. But I'm singing to the choir here, but whether I was singing to you or I was on CNBC right now, I'd say the same thing. The physical bullion market is changing for the better, while the paper market, particularly one that has been running what I've nicknamed, and I'm not the only one, I call our COMEX the CRIMEX, that may still have an influence, but it's deteriorating and it doesn't have the long-term effect that it once had. Just before you and I sat down to record this, someone had noted what some statistics that have been happening in the COMEX in recent weeks that help explain, I think, why we had this most recent decline. And yes, there is manipulation. And yes, 10 or 15 years ago, when I and others that spoke at conferences all around the world, we were called crazies when we said people manipulate the gold and silver market. But most recently, we saw some people actually go to jail for doing it. So we weren't that crazy to begin with. Unfortunately, the ability to manipulate the paper market disguises but helps people who play the short side of the paper market to recover and profit from it. But the physical market is growing stronger. Patrick, there's no question now that your part of the world is taking more control of the physical metals markets. And that's a good thing because people in your area of the world pretty well understand the value of something that's worked for a few thousand years, physical metals. We're here in the United States, everything is paper and debt, and it's not our second nature to look at physicality. And look at my neighbors to the north, who at one time, a great natural resource country, years ago, they liquidated all their government holdings of gold. So they don't have an incentive. And I think it's one other important, it's not a cop out, Patrick, but it is true. I think it's important for people to understand, at least here in the United States, the financial service industry treats gold and silver like kryptonite. They have no incentive or desire to see their clients own it for a couple of reasons. One, it flies directly in the face of what they make their living off of. You're not going to have $2,500 gold and a 50,000 Dow. It's just not going to, those two things are not going to happen in our lifetime. And since they really have bet their lungs on a 50,000 Dow, they're not going to promote or suggest anything that goes against it. But it's very difficult for the American investor when I sit them in my planning group and say, listen, I want you to own some physical gold and silver, but I also want you to hope it doesn't go up. And Patrick, they almost all say the same thing literally. Excuse me, Mr. Grandich. You want me to put money into something that you hope doesn't go up? That's un-American. And I turn to them and I go, listen, the reason I say that is because if it does go up, what you probably own a lot of went down. So you buy home insurance, you buy car insurance, you buy health insurance. I want you to buy money insurance, and that insurance is sold at the gold and silver corner.
The most significant surge in money supply occurred during the weeks ending on March 25th and April 1st, with the assets of the Federal Reserve increasing by 12.6% and 10.6%, respectively. This substantial rise in assets reflects the Fed's efforts to inject liquidity into the financial system through various mechanisms, including bond purchases. As of February 26th, the Federal Reserve's balance sheet had reached a total of $4.16 trillion. Notably, around mid-April the previous year, the size of the U.S. Federal Reserve's balance sheet had reached its peak at approximately $8.97 trillion. This remarkable doubling of the balance sheet occurred in the wake of the COVID-19 pandemic as the Fed engaged in substantial money creation and bolstered the financial system by purchasing bonds. In his analysis, Peter points out that while the Fed's monetary expansion was a response to economic challenges, it also led to unforeseen problems. This observation underscores the complex dynamics of monetary policy and the consequences of significant money creation. Let's get back to the interview.
The problem is that we now have a Fed that's really been misguided in its assessments for quite a few years. First, it got overdone on the loose side, the monetary looseness. Of course, COVID really created that monster by trillions of dollars being printed to supposedly save the nation. Which part of the reason it had to do that is because we go back to what we pointed out before: 2/3 of the country's working paycheck to paycheck. Within 30 days, most people would have been in serious problems. It also went out and bailed out zombie companies, we call them, companies that were not in good shape, but got a lot of cheap money. And those people are back at the spigot now. They got to go back and refinance, and they don't have that cheap open spigot anymore. That's going to be a problem on the corporate debt side here. But I think the other thing that you have to look at is that the Federal Reserve uh, may be perceived as thinking in our best interest, but its really job is to protect the banking system, and the banking system is greatly influenced by a certain amount of powerful people. And it's always going to err on the side for those powerful people, not for the average working class person. And so we have a real quagmire here now, Patrick. So much of our banks who went out and invested in US paper on the bond market side, not risking in equities, all those holdings now are at a loss. I mean, we're looking at unprecedented third year potential losses for bonds. And so all these banks that are struggling because we're slowing down, they got a lot of real estate exposure, are also holding paper that pays interest of 1, 2, 3% in a 4, 5, and 6% environment. They're all at substantial losses. And God forbid that people ever started to think, wow, the whole banks are bad, and started pulling money out, and these banks have to sell those items in order to raise to pay their depositors. That's the big thing that's gone away from the media and people's attention, but really hasn't gone away technically from what we saw a year or so ago when some of the big banks that were caught with their pants down, and we saw what happened there. So that could be one of the negative surprises if interest rates keep ticking up, that we could see another bank fiasco here in the not too distant future. And can I just interject here one thing, Patrick, for people that may not know me? I don't sell or benefit from any of this happening. I don't have dry food. I don't sell guns, land in the woods. It hurts my general financial planning business, which I still live off and all. But these things are unprecedented. That's what annoys me about mainstream financial media here in the US. If you turn on our so-called major networks, this conversation, you and I, would have been stopped minutes ago. You and I would have been asked to leave and never come back. So I just want to make sure people understand that I'm not trying to say this because I'm somehow going to benefit from it. I'm actually going to suffer from it just like everybody else will.
The balance between market manipulation, central bank policies, and economic outcomes is a multifaceted aspect of the financial landscape, and it raises questions about the role of precious metals in such an environment. How will the delicate interplay between market dynamics, central bank policies, and economic factors continue to shape the landscape for gold and silver? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being part of our community.